Hi traders, today's video is achieving a favourable risk to reward target. And in today's video I'm going to go through the following topics, and they are your trade setup, buying the dip or selling the rally, Fibonacci Tool, and we'll go through some chart examples. Now, achieving a favourable risk to reward target is essential when trading. So stay with me to the end as I walk you through the key elements to achieving a 1 to 3 or 1 to 4 risk to reward target on your profitable trades. Introducing myself, my name is Duncan Cooper. I'm a full-time trader and the senior market strategist and trading mentor at ACY Securities. Okay, let's get into the first topic. Now, I've discussed this before in a previous video, so this is just a review of some important information. So when trading, your trade setup needs to achieve a win to loss ratio of at least 50-50 over a series of trades. Your targets need to be set at a 1 to 2 risk to reward or greater. And this is important, your risk to reward targets need to be achievable. And today I will show you how I go about achieving that. Now let's discuss buying the dip or selling the rally. So to achieve a 1 to 2 risk to reward, look to buying the dip in an uptrend and selling the rally in a downtrend. And I'd recommend that you trade in line with the day chart trend. So if the trend is up, look to buy the dip, and if the trend is down, look to sell the rally. Alright, let's have a look now at the Fibonacci tool. Okay traders, let's have a look at the Fibonacci tool and using it to create great risk reward targets. Now, I like to use it in line with the day chart trend. I can be using it on the day chart or the 4-hour chart, and I like to use it across a range of 100 pips from higher low to higher high. So it's drawn from the low up to the high, the tool, and then what I like to look for is the price to pull back to 79% level and enter at that level. So taking an entry at the 79% level on a pullback, buying the dip, and putting my stop 1 pip below the low here. And then of course I'm looking for price to hold, and obviously price to move up from this level up through to the higher high, and ideally up to the 127 extension level. So two targets up to the last higher high, target 1, target 2, up to the 127 extension level. So let's now have a look at what kind of risk reward you can create by using the tool. Alright traders, so looking at the risk reward, so buying on a pullback at the 79% level, stop goes below the low, and I'm just going to use an example of trading a 100 pip range here. So if I'm entering at the 79% level, stop below the low, 1 pip, I'd actually be risking 22 pips. So what I like to do is when price moves up, when I'm up, what I'm risking, so when I'm up 22 pips, I'll take the trade to break even. Now if price continues up, once we just get beyond the 38% level, you'd be achieving a risk to reward of 1 to 2. So price is moving up. If we get to that level, you're now at a risk to reward target of 1 to 2. If price comes up and meets the last higher high, you're now meeting a risk to reward target of 1 to 3.5. And if price continues up to the 127 extension level, you're now achieving a risk to reward target of 1 to 4.7. So by using the Fibonacci tool, buying the dips in an uptrend, it creates excellent risk reward targets. As you can see here, price only needs to move beyond the 38% level. Actually needs to go to the 35% level. It's not shown on the tool, but in terms of maths, if it moves above that level to the 35% level, you're then achieving a risk reward target of 1 to 2 on your trade. Alright, let's have a look now at the downtrend example. Alright traders, so the downtrend example is just the uptrend example in reverse. I like to be using on the daily chart or the 4-hour chart in line with the day chart downtrend. Using a range from lower high to lower low of 100 pips or greater. So with that being said, you draw the tool from high to low across the range, and then I'm looking to sell at sell at the 79% retracement level when price gets there. I put my stop 1 pip plus a spread above the high, and then obviously I'm looking for price now to decline down from the 79% level. First target is the last lower low, and if price can further decline to target 2, which is the 127 extension level. Alright, so let's just review now the risk reward potential of getting in at that level. Alright traders, so it's the same as before, but it's worth going through again. Entering at the 79% level, stop above the high. Again, I'll just use the example of using a 100 pip range. So in this example, because I have to factor in the spread, I'd be risking approximately 24 pips on the trade. So when price moves down 24 pips into my favour, I get the trade to break even, and then as price further progresses down, once we just get below the 38% level, it gives you a risk reward target of 1 to 2. If price moves further down to target 1 at the last lower low, your risk reward target is 1 to 3.5, and if price can further progress down to 127 extension at target 2, you then have a risk reward target of 1 to 4.7. So again, using the tool to help you buy the dip or sell the rally in this case helps you create favourable risk to reward targets. Okay, now let's go to the MetaTrader 4 trading platform and look at drawing the Fibonacci tool across a chart. Hi traders, just on my dollar Canadian daily chart. Now I'm just going to add an indicator. I've done this before and shown you how to do it. Come up to the navigator button, left click. Just going to put on the fractal indicator to show me the significant highs and lows. So left click, hold and drag onto the chart. Click OK, and then it's on your chart. Just come up and left click on the navigator button to close that panel. So what I can see here at the moment is that price has moved up from a double bottom, but it's moved up to a fresh high up here, so we have an uptrend. So coming up to my fib tool, left click, I'm going to position it on this low, left click, hold and drag up to the high. And what I can see is price has pulled back to the 79% level. So theoretically, buying a dip within the uptrend has occurred here. I get my tool, my drawing tool in here. We've moved up to a higher high, then we've pulled back to the 79% level and gave you an opportunity to buy at the 79% retracement level, and we can see that some support is coming in here, and we don't know yet as to whether price action is obviously going to move up. Can we get the trade at break even? Can we meet our 1 to 2 target? Can we meet the 3.5 risk reward target, or can we meet the 4.7 risk reward target? Time will tell. So at the moment, all I can say is that it has pulled back to the 79% level, starting to hold in the short term. If you're trading at the 79% level, have you stop 1 pip below the low here, and then you're just monitoring. First of all, you want to get your trade to break even, and then you can monitor to see how price is progressing upwards to meet the risk to reward targets. Okay, so that's an example there on the day chart. Now just clear that off. Within that day chart uptrend, what I've noticed is there's actually an uptrend starting to form here. We've moved up to a higher high here from the final low. So I can draw in a fib tool, and as I say, I like to trade ranges of 100 pips or more. Now this is in line with the day chart trend, and the 4-hour trend is up, and currently price has moved up, started an uptrend on the 4-hour chart in line with the day chart trend, and it's pulled back to the 62% level. Now it hasn't yet pulled back to the 79, so will it or won't it? Of course, sometimes it doesn't pull back to the 79% level, it just holds at the 62, but getting at the 79% level putting your stop below the low gives you the best risk to reward target opportunities. Okay, so I'd be waiting for that pullback if I was wanting to trade there on that 4-hour range. Alright, let's have a look at another example, this time a downtrend. Alright traders, so here I am on the New Zealand dollar day chart. This is in a downtrend. It's making lower tops and bottoms, lower top to a lower bottom. So get your fib tool, left click, this time draw it from high to low, left click drag to the low, let go, and what we can see is the price has moved down. It's having a corrective rally back up to the 79% level. So there it's giving you the opportunity to trade and sell, stop above the high, 1 pip plus spread, and then we just adjust the scale there. There's the 127 extension. Of course, price action has moved down with the trend. It's rallied back up to the 79. Stop goes above the high here, and now the question would be, if you've entered at the 79% level, if price moves down, get the risk out of the trade when you're up what you're risking, and then can we meet the 1 to 2 risk to reward target, the 1 to 3.5 risk to reward target, or the 1 to 4.7 risk to reward target. Alright traders, so that's how I'm using the Fibonacci tool to give myself favourable risk to reward targets. I hope you found the video helpful, and look forward to seeing you in the next video. Now if you're interested in improving your trading, why not join me in my free beginner webinar series? You can register by using the link in the description below. All those that attend the webinars get full access to my own MT4 chart layouts and indicators. Okay traders, thanks for watching, and I look forward to seeing you in the next video.